What if I told you that one of the greatest money managers in history averaged a 29.2% annual return for 13 years straight? But the average investor in his fund actually lost money. Wall Street wants you to believe you are dumb money. They say you need a $20,000 Bloomberg terminal and a math degree to survive. Right. But from 1977 to 1990, Peter Lynch ran the Fidelity Magellan Fund and proved that completely wrong. He did not use complex algorithms, he used common sense. Dumb money is not actually dumb, it is just listening to the wrong people. Here are 6 surprising lessons from the legend of Magellan that can tilt the odds back in your favor. First, your amateur status is a competitive superpower. You might feel disadvantaged without a team of analysts, but being small is a massive structural advantage. Wall Street fund managers suffer from a capital dilemma. When a fund manages billions of dollars, it cannot invest in small or medium companies where the real growth happens. Those positions would not move the needle. They are forced to fish in a crowded blue-chip pond where every piece of information is already priced in. But here is the catch. Professionals are also plagued by street lag. On Wall Street, a stock is not considered safe until it has already multiplied in price and been acquired by dozens of other institutions. They are trapped by herd mentality and pre-approved lists. The goal is often to avoid looking bad by losing money in a safe stock, rather than taking a chance on an unknown winner. The individual investor, however, has on-the-ground expertise. You might notice a long line at a new local store months before a Wall Street committee reviews a 20-page analyst report. As Lynch said, people should stop listening to professionals because any regular person who uses at least 3% of their brain capacity can pick stocks efficiently, just like an average expert on Wall Street. Now look at this data point. It is called the Magellan Paradox. While Peter Lynch was returning 29.2% annually, the average investor in his fund earned only about 7%. A significant portion of investors actually lost money while he was hitting home runs. This discrepancy is driven by destructive behavioral psychology. Investors cycle through 3 emotional states that lead to buying high and selling low. First is concern. They wait until the market drops to feel safe, missing bargain prices. Second is complacency. They enter only after a bull run pushes prices to all-time highs, assuming the good times will last forever. Of course. Third is capitulation. When the inevitable correction occurs, they panic and sell in a snit, locking in losses at the exact moment they should be buying. To succeed, you must discipline yourself to ignore your gut feelings. The stomach is more important than the brain in investing. If you cannot handle the sight of your holdings dropping 20% without panicking, the stock market is not for you. Before you scan a single stock chart, you must pass the mirror test. Lynch argues that a primary residence is the only truly rigged investment that favors the individual. It gives you leverage with a 20% down payment and offers massive tax benefits. But its greatest advantage is psychological. People are geniuses at buying houses. They spend months researching the neighborhood and the foundation, and they hold for decades. Conversely, they spend minutes choosing a stock and sell it the moment a bad headline appears. Before buying a single share, answer 3 questions. Do I own a house? Do I need this money in the next 2 or 3 years? And do I have the patience and self-reliance to ignore general panic? Only invest what you could afford to lose without affecting your daily life. Let's zoom out for a second. Wall Street loves sexy stocks in high-growth industries. Lynch preferred the exact opposite. He described the ideal company through a fictional entity called Cajun Cleansers. Cajun Cleansers removes mildew stains. It is a dull, disagreeable, and depressing function. To Lynch, the perfect stock has a boring name, a disagreeable function like a mortuary or toxic waste processing, and is surrounded by rumors about the mafia. Sounds great, right? This is exactly what you want. When a company is boring or disgusting, Wall Street ignores it. This allows you to build a position at a steep discount before institutions finally catch on. Contrast this with whisper stocks, which are the hottest stocks in the hottest industry. They are hypnotic, but lack substance. When the hype fades, there is no stake behind the sizzle. Lynch warned that there is no next Home Depot, no next Amazon, and no next Costco. It is better to buy the original good company at a high price than to jump on a copycat at a bargain price. Now, let's talk metrics. Lynch was a pioneer of growth at a reasonable price. He believed a high price-to-earnings ratio is not necessarily bad if the company is growing fast enough to justify it. To find these opportunities, he used the PEG ratio, that is, the price-to-earnings ratio divided by the earnings growth rate. A PEG of 1.0 is considered fair value. Anything below 1.0 is an attractive bargain. Consider two companies. Both have a price-to-earnings ratio of 30, but Company A has an earnings growth rate of 40%, giving it a PEG of 0.75. Company B has an earnings growth rate of 15%, giving it a PEG of 2.0. Even though both have the same price-to-earnings ratio, Company A is the superior investment because it is cheaper relative to its growth. For slow growers that pay dividends, Lynch added the dividend yield to the growth rate to find the adjusted PEG. Finally, we have the 2-minute drill. Before purchasing a stock, you must categorize it into one of 6 buckets: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. Once you know the category, you must perform a 2-minute monologue covering the reason for your interest and what must happen for the company to succeed. If you are buying a stalwart like Coca-Cola, your drill might sound like this. Coca-Cola is selling at the low end of its price-to-earnings range. It has increased earnings consistently, and its international sales are exploding with a 36% increase in Japan alone. They recently bought out independent regional distributors, giving them better control over margins. If they continue this international expansion, they will do better than the market expects. If you cannot explain why you own a stock in a way that a child could understand, you are not investing. You are gambling. The stock doesn't know you own it. It does not care about your feelings, your break-even price, or your desire for a quick profit. Successful investing is not about predicting the direction of the market or interest rates. It is about finding solid businesses and holding them as long as the fundamental story remains intact. Investing is a gamble where you have managed to tilt the odds in your favor through research and patience. The next time you are at the mall or your workplace, look around with a skeptical eye toward the hype. Are you just looking at a consumer product, or are you looking at your first 10-bagger? Let me know what stock you are watching in the comments below.